So it's not quite 1992, and I bring 1992 up because that's the only year that I've ever seen where supply exceeded demand. And that was because of the S&L crisis and the fact that the RTC was dumping hundreds of properties every week on the market. No one had any capital. Properties were languishing on the market. That was the worst market I've ever seen. It's not quite like that, but it's eerily like that. We're selling a multifamily portfolio up in the Bronx, an 8-building portfolio worth about $50 million. Bids were topping out in the low to mid 40s. The sellers decided not to sell. And we were talking to the property manager, and they said, we manage 7 large portfolios in the Bronx. They have all been on the market, and none of them have sold. So I think what we're seeing is that a larger proportion of what is on the market is not trading. And why is that? So we've said supply seems to be good. If we look at the number of properties that we're evaluating for potential sale, those numbers are consistent with what our historical averages have been, if not maybe up a little bit, so maybe supply is a little higher than normal. But what's happening on the demand side? So if we look at demand drivers, you have high net worth investors, New York City families, institutional capital, foreign individuals, and foreign institutions. So what is happening with each of these demand drivers in the market? Well, high net worth investors and New York City families are increasingly looking to buy outside of New York today. That is the thing that I find the most troubling. I think there are political reasons why that's going on. There's also, even though the market is in this kind of funky place, cap rates haven't gone up that much, so you still can get better yields outside New York. So we have a lot of clients that are saying, hey, look, I'm not going to get the same appreciation if I go buy in Boston or Philadelphia or Washington, but you know what, I'm going to get 50% higher returns. And because I'm not a fund and I don't have to sell at any particular time, and I'm a generational owner, I'd rather get 50% more yield, and I'll worry about my appreciation down the line. So I think when you have things like politicians driving what could potentially be the largest employer in the history of New York out of the city, and you have real estate tax policy where if you own multifamily buildings and you have 35% of your gross revenue is going to real estate taxes with no end in sight, and you have policies that are making it more difficult to operate, at some point it becomes problematic. And this is probably the most troubling trend that we've seen in the market, is people wanting to put capital outside New York rather than investing in the city. Institutional capital is plentiful. There is a ton, billions and billions of dollars of institutional capital that are looking for investments, but increasingly their expectation for yield is not meeting where the market is, or I should say the sellers are not capitulating to the point where institutional capital is ready to be deployed. And the returns that institutions are looking for today, which would have been returns on core assets years ago, they're willing to take the same returns on opportunistic investments today and still have trouble deploying that capital. So it's hard although the capital is there, it wants to be deployed in New York, it's having a tough time finding sellers who are willing to sell at prices they're willing to purchase at. And foreign capital, where do the foreign investors go? I wrote a piece about 3 months ago in the Observer where I said, look, foreign capital is down as a percentage of the capital that has been deployed into the marketplace, but it's still at healthy levels. So let's take a look at that foreign capital, because I think it's so interesting. If you look at the years 2015, 16, and 17, foreign capital made up about 41 to 44% of the total capital invested in New York City. In 2018, that amount dropped to 23%, but the amount of capital that was deployed was still very, very healthy, of $6.4 billion. Compared to prior years, other than that run-up 2015, 16, and 17, when particularly Chinese institutions were dumping tons of money into the market, that 6.4% was very healthy. But look at where it is today. And one quarter is not, you can't read too much into one quarter. 2 or 3 quarters kind of make a trend. One quarter can be a little aberration, but it's only 6%, and annualized that'd be 1.1 billion, which would be the lowest annual total going back to 2009. So why aren't those foreign investors deploying capital here? Part of it is we understand a lot of that foreign capital is going to other cities around the United States, not coming into New York, but that is absolutely a concern. And if we look at how the market has changed with that foreign capital from 2015 to the first half of 17, in those 10 quarters, it was $4.8 billion a quarter was pumped into the New York City marketplace, whereas for the last 7 quarters, it's been less than a third of that. So that's another trend that we're concerned about. And we'd love to see that foreign capital coming back to the marketplace. So I'm going to turn it over to my buddy Aaron, and we'll take some questions and answers afterwards. Thank you.